Hello everyone, welcome to YouTube channel. So I hope all of you are doing great. This session I would like to start with an interesting question, and the question is like, have you ever wondered what would happen if a massive natural disaster hits a country? Like, where does the government suddenly get the money to rebuild homes, rescue people, and provide relief services? As we have noticed that monsoon has arrived, and we saw that various cases of natural disasters like flooding, landslides, cloud bursting, right? All these natural phenomena has devastated our economy, and there is a huge loss of infrastructure and, of course, human lives as well. So any natural disaster, when it occurs, it causes a lot of misery to the people, and also it hits our infrastructure of the country. So how government deals with it? In fact, there are many ways to deal with such a natural disaster, but in today's session, the topic which I'm going to talk about is it's something called catastrophe bond, or we can say cat bonds. So these are the bonds which may help the country to rebuild their infrastructure, to rebuild the economy when it hits from any kind of natural disaster. It can be like a earthquake, tsunami, landslides, floods, etc. So it is like a safety mechanism. Okay, so let's understand what actually catastrophe bond is. So now let's understand what exactly a catastrophe bond. Think of it like a mix between insurance and investment. Let's start with an example. Imagine a country like India or a Nepal, and you know that these countries, especially the South Asian belt of countries, so they are more of like a risk prone areas like earthquakes or floods, right? So if they goes to investor and if they go to investors and says that hey, can you lend some money for the next 3 years, so if no disaster happens during this time, I will return your money with a nice fat interest. Now that sounds great for the investor, right? That after 3 years I will get a huge interest. But here is the catch. Now the country also says if something terrible does happen, like a massive cyclone or earthquake, I will use that money to help my people, rebuild homes or all other like hospitable work, right? And yes, that means you might not get your money back. So it means when investor is investing a money, and due to that contractual time frame, any kind of natural disaster occurs, so that country is free to use that money and not liable to pay that money back. So it's like a mutual condition. And yes, there is a catch, like if no disaster occurs in those 3 years, so country has to pay back that money with the interest. So it's like bit risky also, right? So it's like invest in my safety net. If I don't need it, you win, but if I do, your money becomes a lifeline for thousands of people. So it's like a cat bonds are not just about making money, they are about sharing risk. Here both parties are sharing risk, and it's like more of like on hope based. So now, and we can say that it's a smart finance like for a risky world, right? Imagine like a country, India or Nepal, which faces risk from earthquake or floods. Okay, now these countries, what they will do, they will ask any investor like, can you lend me some money for the next 3 years? So the condition is like, if no disaster happens during this time, I will return your money with the nice fat interest. Okay, so what's happening? Country is asking a money from an investor for a 3 year. If any disaster If any disaster doesn't occur, then we'll return the money with the high interest. Now it sounds great, right? But here is the catch. The catch is that country will say, if something terrible happens in between, like a massive cyclone, earthquake, tsunami, etc., then all that money which I have purchased from you will use that money to help my people during the disaster, and hence country is not liable to repay that money. Are you getting? So it's like a risk from the both party side. If there is a natural disaster, investor will not get the money, and if that natural disaster doesn't occur, then country is liable to pay that money back with the high interest. Okay, now now an interesting question is, why investors buy a cat bonds? And here is the answer: because with cat bonds the rewards can be huge. Like these bonds offer much higher returns than any regular borrowing back bonds. So comparatively high interest rate is there. And the cool part is that these cat bonds are not connected to the stock markets. So even if the stock market goes on a roller coaster ride, your cat bonds will stay steady unless a disaster hits, of course. So we can say that it's a well calculated risk. Some investors like playing it safe, and others, they are willing to say that okay, I will take the risk if it means I get a big return and maybe even help people in the process. So yeah, cat bonds are not for everyone, but for the right kind of investor, yeah, we can say that. And they are bold, smart move in a risky world. So it's like more of like whether you want to take the risk or not. And of course, if the luck is with you, you may get a huge interest rate, right? All right. So what we learn today, like catastrophe bonds, so they are not just some complicated finance stuff. They are actually really smart way of countries to prepare beforehand from any kind of natural disaster. And if I talk about from the investors end, well, it's luck on their side. They could walk away with a solid return, but even things go wrong, their money could be saving lives. So that's not just investing, it's impact. So what do you think? Would you invest in a cat bond, or is the risk too real? Let me know in the comment section. And if this helped you understand a big concepts in a simple way, don't forget to like, subscribe and share with someone curious like you. See you in the next one. Thank you.